Okay, good day, everybody. This is the Option Professor speaking, and it is regarding the psychology, the discipline, and time management in trading. And just a quick background on myself. I've been in this investment arena here for about 40 years, and I'm very familiar with all different types of investing, from income investing to stock investing, international investing, different energy investing, commodities, and different sectors. So again, over that time, we've obviously learned quite about all the different markets. And of course, as far as options are concerned, I've conducted many hundreds of seminars nationwide and have educated thousands of people on the uses and risks of options. So it's something I've specialized in my career and basically something I'm very familiar with. Also, haven't been around for so long. I've seen a lot of educational programs come and go, and a lot of things happen with regards to different newsletters and all kinds of things like that come and go. So I'm pretty experienced on what people are out there looking at. But today I'm going to be speaking about those areas I just mentioned: psychology, discipline, and time management, and some of the ways that I go about looking into those areas. So today, again, is going to be my opinions. And certainly this is not going to be giving any advice to anybody, but just my opinion I'm sharing with you. You should always consult your brokerage firm to discuss your suitability, risk tolerance, and all those factors before you get into anything. So that's the main thing. So without further ado, I would like to start out by psychology in the trading world. We do have a situation where people, when they're dealing with real money, sometimes get extremely emotional. And if you don't have some kind of a discipline approach, it can be very difficult for you to be successful. Now, in my opinion, the psychology that I like to enter into something with is something where I'm using risk management from the get-go, which means if I'm looking at an opportunity, my psychology is one of, I want to make sure that the risk of this transaction is under control and within the parameters of what I am interested in taking on. What you don't want to do is get involved in a lot of willy-nilly trading where you're just emotionally buying and selling. Your sizing, is all over the place, meaning you do different amounts of contracts all the time. And then with that type of, shall we say, unsettled type of mentality, it's going to be very difficult to be successful, in my opinion, because you're depending upon an awful lot of luck to kick in, and we all know that luck runs out. So the psychology I like to start out with when I start getting involved in any type of trading is the risk side of it. Okay, I'll give you for instance here. What I like to do as far as looking at a turning point is, and I'll get into some of the disciplines that I use to figure out when to buy and sell. But to give you an idea here, if I'm looking at a turning point on something, and I might be getting a divergence in the relative strength, which is telling me that the new high in the market or the new low in the market is not being confirmed by the RSI, which means there's a probability of a turn. For instance, if a market makes a high and the RSI is at 75, makes a new high and the RSI is at 59, that's a divergence, and ergo I'd be looking for a place to sell. Now, if I go and say it's on the S&P like you're looking at now, if I do a contract on that, there's going to be leverage involved. And if I'm wrong, it's going to be a situation where my loss could be rather dramatic. Let's just say, for instance, I thought 4,200 was a place to sell. And so I went and sold a contract at 4,200 on the S&P, and I hold it overnight. And all of a sudden, the S&P jumps up to 4,275 the next morning. That's a gap of 75 points. That's going to be a big ding on my account. And that's a risk that I'm not interested in taking based on my psychology of risk management as I go into a trade. So what I might do is substitute a limited risk option strategy where you take a short-term option, maybe a one-week situation, like say you're looking at Monday. And as an example here, you would go into a Friday option. And let's just say I would probably go a little bit in the money. So I have an in the money option, which with only a week to go is going to have intrinsic value and maybe not too much time value. So I'm going to be able to, if I'm right and the market were to drop on this put option, it's going to participate in the drop pretty well because there's not much premium in it because, again, we said it was only a week option. But what it does give me is limited risk. And I'll give you, for instance, here, like just as an example, if you did a 42.10 put, if the S&P was 4,200 and there wasn't much time premium in it, and say the S&P went from 4,200 down to 4170 by the end of the week, and you thought it was going to continue, and you say you did it on SPYs, SPY, because they would have options on it that you could trade. Now you're in the money big time because you actually are correct. The indicators you used were accurate, and the market made a big drop, and now your option is deep in the money. You can elect to let that go into what they call exercise, and then you'd be short the market at the striking price. In this example I just gave you, say 42.10, and you can hold on to it and then trade it as a short position. Of course, at that time you don't have limited risk any longer, right? So that's a different risk. So you might want to do something with regards to a hedging tactic or a stop loss situation to try to monitor the risk management at that point. But the entry using the put option in lieu of a contract fits into the psychology of, I don't want to get into something that might be a big loss if I'm wrong. And again, if you're taking positions that are leveraged overnight, obviously a market can have a big adverse move and be a very big problem for you. So again, that was an example of the psychology of when you enter into a trade. Sometimes if you can use a limited risk option to get in, it'll limit your exposure, and then you can use that in the money option in that example I showed, and you could actually let it go to exercise and then take a sell position, or if you bought a call because you thought it was going to go up, you could let the market go into where you take delivery of the long position. Now again, this strategy is not right for everybody. You got to talk to your broker to find out what your suitability and risk tolerance is. But I'm sharing my opinion on a way of entering and fitting into the psychology that I'm trying to work with you on, is that you have to protect your risk capital because that's what you've got as a certain amount of money to risk, right? So you don't want any one trade to be that problematic. So if you go into every one with the psychology of how much I can lose on this thing and what kind of staying power I will have, then you could look to see maybe using some of the limited risk options in certain ways to try to get an entry into something. Particularly, that's why I believe, in my opinion, why these very short-term options have become so unpopular. Because rather than using leverage on some of these other vehicles, you can use a option, even if it only has a short few days in it or less, as an entryway to get in. And you get the leverage because every option is 100 shares. So you still get some leverage, but you get that limited risk. So if you're totally moronic on your idea, you can only do so much damage to your bankroll. And again, in any game of chance, whether it be trading or any other type of game of chance, managing your bankroll is extremely important. So in my view, you want to get the psychology on, I'm going to go into this idea because I think it's good, but I would like to go into it with the psychology of risk management right from the get-go. And I think that's very important. So that's an example of how you can kind of do that. Again, the use of options in connection with positions can be a very effective way to get leverage and limited risk at the same time. And again, my personal opinion is if you are looking at a turning point, sometimes a in the money option, which might cost a little bit more, obviously, but it also gives you a better break even. And if you're dealing in a short period of time as far as expiration, you certainly want that. And then, of course, if you are correct, it can become a deep in the money option. And then, of course, you've got a number of different alternatives at that point. Once you have an option that's deep in the money, again, you could do, like I mentioned, let it go to exercise and then take a short or long position depending upon if it's a call or a short, a call or a put. And again, you have to have the finances behind that. And then you just want to transfer your risk management into stop losses or spreads or some type of hedging, because you always want to be thinking risk management when you're trading. That's the psychology, I think, that'll keep you in the game longer. Again, tactics work and sometimes they don't. So what's the key? The key is that your psychology is, I'm going to manage the risk here, and then the reward will take care of itself. So that's what I would share with you as my input as far as the psychology of trading. Again, start with risk management and end with risk management, okay? Because those who don't, obviously, they can be very, very successful, but luck does run out, and then, of course, your capital's gone, and once that happens, you're out of business, and, of course, that's not a good thing. With regards to discipline, okay? As far as discipline is concerned, and of course, discipline is also part of psychology, because, you want to be a disciplined person, which means you're going to have the psychology of, I have rules and regulations, or I have parameters. I follow my parameters, and basically I am disciplined to following the parameters. I'm just not going to change my mind anytime I want, because you've done homework and research on your parameters and your methodology. And you have found by back testing it, maybe paper traded it, whatever you want to do, that it is effective. So that's the discipline. Now, there's a lot of disciplines out there. I mean, I go on to some of these websites and I look at technical indicators. And, over the last 40 years, how many have grown? I mean, some of these things I've never heard of before. Some of them I have. Some of them are fairly new. Some have been around for a long time. But I've gravitated, in my opinion, to some things that I think are effective over time. Now, the two areas that I find most effective over time are the moving averages, because they're based on price and time, right? They're not based on opinion. Now, they don't tell you where things are going, but they obviously give you an idea of where they've been coming from. And there is the theory that people believe in sometimes called the body in motion tends to stay in motion. So that's why the moving averages are very interesting to me, because it gives me the idea of what the motion has been into this level. And then basically the second area that I find interesting is the relative strength, because in the relative strength, I'm getting an idea of the momentum. So the two areas that I have gravitated towards as being the most effective and giving some peace of mind are moving averages and the relative strength index. One is to determine the flow of action, and the other is to give you an idea of up or down momentum. Now, the beautiful thing I find about the moving averages, they also give me an idea of overbought or oversold. And when the market is extremely far above the moving averages, my view is it's not if that market's coming down, but when. A good case in point would be oil when it hit 131, and all the moving averages I had on the longer term charts were down in the 50s, 60s, and 70s. And again, many people would have found it shocking that crude oil would ever drop from 131 last year all the way down into the 70s. It seemed far-fetched and crazy, because it actually was making an attempt to take out the 2008 high of 147. Of course, that failed. I thought it would fail, so I had an opinion. But my opinion was also confirmed by the fact that once it started to roll over, there was so much real estate between the current price and the moving averages. That's exactly what reversion to the mean is all about. So once you get a market that's way above the moving averages, Tesla was another one, you've got to be thinking it's going to turn. And then you look to some of your shorter term moving averages to get an idea of if the turn is actually happening. So as far as the discipline is concerned, I have averages that I use, which, again, we share with people who contact us. And I look at the markets on different time frames, okay? I look at it on a 20-year basis. Then I look at it on a 5-year basis, a 1-year basis, and then basically on a 1-month basis. That gives me the perspective, obviously, of a very macro picture on the 20-year, a less macro, but still longer-term picture on a 5-year, and then, of course, a relatively, a reasonable amount of time as far as there's a decent amount of data on a 1 year. And then on a 1 month, you're really getting an idea of what the short term is looking like as far as a turning point, trend, and et cetera. So again, I'll give you a good case in point that on a stock that I had a personal experience with, Freeport McMoran. It went down underneath $10 a while back, not that long ago, but a while back. And it had come down from like 50, 60, 70 or something like that. But I would have never known that if I didn't look at the 20-year graph. So when I looked at the 20-year graph, I saw a couple of things going on. One is the longer term averages were starting to turn up, which is not easy to do because the longer term moving average you've got, the more difficult, more time it takes to turn them. So when they do turn, it's very important in my view, because that means there's been a lot of evidence indicating that the rolling over in the other direction has begun. And so in this particular case, Freeport McMoran was underneath 10, and it started to go. So I took a position, but I put it in the IRA, where obviously I could defer gains on the taxability of it. And also you sit, generally with IRAs, you sit with them quite a bit. And so I did, and the stock went all the way up to like 50 from underneath 10, which is a heck of a move. Now, when it got up to that level, the moving averages were down in the 25, 35 area. And so obviously it had that idea of reverting back to the mean again. So obviously up in that area, the indication was more of a sell looking for a reversion to the mean, of which it did. It went back to the 25, 30, 35 region. And so that was a place to consider reentry. So the moving averages can not only tell you, in my view, what has been happening. Of course, there's no crystal ball telling you what's going to happen. So you're trying to get an idea of what the flow of traffic is and where the price is in relation to what I call the mean, which is the longer term averages. So again, the moving averages are very helpful to use, and again, they do give you a discipline. If you use a certain moving average combination, which I do when I do homework, if they violate these numbers, you have to act accordingly. And the direction of the moving averages are very important, particularly on the 1-year moving average. You'll not find too many times where you get an extended move in any direction without the actual direction of the moving average being in that direction. In other words, if you think you're going to have a substantial move to the upside, the 1-year moving average is generally going to be pointing in that direction if it's going to be rather lengthy and sustained. Same thing on the downside. It's very difficult to get a big down move in anything if we have not turned over some of these moving averages and have them pointing in your direction. So the direction of the moving average, very important. And then, of course, the time frame. And again, we use a combination of moving averages. And that, to be honest, that's the key. I mean, some of these things you might say, "Oh, I know moving averages." Yeah, but which ones are you using? Do you know how to interpret them? Do you use any? How do you read them? Because anyone can, tell you, how to shoot a basketball, but that doesn't mean everyone's going to be as effective doing it, even though it's the basic motion everybody uses, right? Or a golf swing would be another example. So again, there is an art and a science. And the science obviously is a moving average. You take X amount of days, you divide it by that amount of days, and then boom, you got a number. And then at the end of the next date comes up, you take the last one off and you put the new one on, and that's why it's moving. But what does it mean? Is it, is the moving average, telling you or giving an indication that the move is just beginning? Is it showing you the move has already advanced quite a bit, and that type of thing? So the discipline of the moving averages come in very good because, we just try to make sure the market's on the right side of your averages. Then you try to let them run as far as possible. You can always do hedging techniques, like I was saying, when oil's up at 131 and the averages are way underneath and you think it's going to come down at some point. That's the area, if you don't want to get out for whatever reason, you might take some option defensive tactics. Like your covered calls, your married puts, your collars, and all those kind of things. So again, moving averages can give you an idea, gives me an idea whether a move has begun, has already gone on, might be in the advancing stage, or it might be in a situation where it could be near the end of the road. So it's very helpful to me. Another good example of a moving average we use, which is a longer term average, which most people would never use. But again, we're looking at all different time frames: 20-year, 5-year, 1 year, 1 month. Now, during the crash of 2020, the S&P hit 2174. Now, that was right on a moving average that we follow. So rather than panicking out at 2174, if you're using this moving average, if it's part of your arsenal, you might have said, hey, no, not only am I not going to panic at 2175 on the S&P, I'm going to maybe take a shot at it here. And if it gets underneath this average, I'll dump. And if you did do something like that, that would have been a very effective way. But you would have never known why it might stop there if you did not have something to work with. And of course, this long-term average that I'm talking about came in right there, which is very interesting. That moving average that I'm talking about that got hit in 2020 now comes in right around 3,000. And as it stays above 3,000, it'll be growing every day. So those people who think that we could have a big sell-off down to 3,200 or something like that, they do have a moving average of which they can refer to. And it's a moving average that does not get hit very often, but it does get hit sometimes. And it definitely gets hit sometimes when there is a big disruption in price. And with the interest rates where they are, and with the inflation, prices paid just came out today, and prices paid on the ISM report is showing a big jump. So it shows that the inflation is still out there. And you're seeing a lot of, the travel, leisure, and gaming stocks continue to go because they're expecting these consumers to keep on spending all spring and summer. So again, we don't know exactly what will happen, but if they can engineer some kind of a demand slowdown later in the year, and everybody, goes to sleep at the wheel without risk, there'll be a lot of people who could maybe roll this thing over to the other side, and maybe in Q4, maybe in Q1 of next year. I don't know how long it'll be delayed, but if the Fed wants 2% inflation, you would imagine some kind of slowdown must occur. So again, there are moving averages we look at that we can sometimes call them attractors because markets tend to go towards the moving average, and then basically, to give us some clues on that. So we use different moving averages, and we use different time frames to give us basically a full perspective on, again, what are the trends here, and where is the market basis the trend. The other thing about psychology that I refer back to is not only do you want to have a psychology of risk management first and foremost, but you also want to have patience, okay? If you wake up every morning and just got to trade something, that may not be right for everyone. So, being selective and waiting for setups and waiting for the technical circumstances to be most favorable to you, that is a discipline and that is a psychology. And it goes really in there with risk management, meaning I'm not going to take a risk just for taking a risk. I'm going to take a risk that I can see the odds look pretty good. I can see that if I'm wrong, that it shouldn't do too much damage to me. And ergo, it fits into the game plan of risk management and also the psychology of, being patient. So remember the patience part as well. It's hard to do, but it's not really hard to do if you don't want to lose money. And so, if you get that inclination that I really don't want to lose money here, you're going to be more careful. You're going to be more selective, and you're certainly going to look for transactions that, if you're wrong on, will not do too much damage to the account. Again, the second part of the discipline that we talked about, which was the moving average, is the relative strength. And on the RSI, we look at, again, the same thing: 20-year graph, 5-year graph, 1-year graph, 1-month graph. Gives us a nice perspective. And of course, we use an RSI on all of those charts. And again, what I have found very helpful is divergences. And divergences on the RSI, I did allude to earlier. is say you have a higher high on a market and the RSI is lower. That would be a divergence. It would indicate that there's a possibility that this thing is running out of steam on the upside in that example, and that I should maybe look for some type of selling or shorting opportunity on whatever market we're talking about. Same thing on the downside, something that's gone into the collapse mode and say it makes a lower low, but the RSI actually is higher than the prior low. That's a divergence as well. And there's no exact science to that. That's where the art comes in. That's where the judgment comes in. But it can be helpful to show exhaustion. And I have found it to be pretty darn helpful. So that's why I'm mentioning it too. So that's the first thing that I think is very valuable from RSI as far as trading is concerned is divergence. The other thing is very helpful is general rules on RSI. General rules, for my own opinion here, is that when the RSI is above 50, that the market is generally in a relatively strong or possibly uptrending situation. So above 50 is a solid situation for the market. Generally, in my view, it's a positive. Now, what if it goes from 52 to 53, and then it goes to 60 and 63? Starts breaking through 60, there's an opportunity there possibly of an acceleration to the upside. So as you go from the 50s into the 60s, then of course you want to be thinking that there could be a real big pop ahead, and that's sometimes where the exciting moves are happening. So again, it's interesting to note on the S&P up here in the 4,200 area, we're right around that 60 number. So it'll be very interesting to see if in fact it will be able to break through, because again, it'll be interesting to see if the relative strength will break through 60 and get us into an acceleration phase, because it could very well do that. I'm watching that very closely right now. Okay, so that's the story on the upside on the RSI. You want it above 50, generally speaking. If you're in an uptrend, you want it to break through 60 and start accelerating if it's coming off of the 50s number. So keep an eye on that. Now, of course, up when it gets into the 70s or higher, then you've got to really start looking for divergence, because that's when the divergence sometimes happen. And those are sometimes some outstanding signals. So again, anything above 75, you're looking to see if there's higher highs with a lower RSI to give you an idea that the volume or the momentum is drying up, and that could give you a nice good sell point. Conversely, let's talk about the downside on the RSI. If it is under 50, you will probably find that the market is generally weak. And you can see on the screen right there that obviously as we broke down in June, we were pretty low there for a while. And obviously that was a situation of it dropping. And once you got back above 50, you were back on the bicycle. And then in late August and September, it started to break down, you can see. And it was pretty lousy until October. And then, of course, since October, it's been pretty darn good, except in late December, got a little shaky there, but then back on the bicycle, and then shaky in March when we had the bank crises. And now it's been back on the bicycle again. So that gives you a little bit of an idea on the RSI. And you'll notice, if you want to see a divergence, go to the September-November timeframe there. You'll see the low on that in that September timeframe, and the October low was a higher RSI. So there's a good example of what I'm talking about. When there's a divergence in RSI, sometimes it's a little bit of a good signal. We'll have to see. Obviously nothing works all the time. So these are things I have on my radar. I put them into my soup, and when the soup tastes right, that's when I'll be more interested in doing something. The other area of discipline that comes in is the Fibonacci numbers. And Fibonacci, the one that I like to use the most, is 61.8, which is a Fibonacci retracement or something that I use from time to time. So it's very interesting to note that if you take the low of 3,500 and you take the high of 4,800, this is rough numbers, you'll get about 1,300 points. And if you take 61.8% of that, you could go into the 4,300, 4,350 region on a rally. So if we were to get above 4,200, 4,210, that would be the neighborhood that I would be looking for the market to possibly stop, because that would be a Fibonacci retracement of 4,800 down to 3,500, which was the lows in October. Again, rough math. So that's another thing that I would be looking at as well. Now, if we got up into 43, 43.50, I'd then look at my RSIs, I'd look at my moving averages, and when the stars align, then of course I'd be very interested in doing something at that point. Another Fibonacci number that's interesting is if you take the low of 2174 on the S&P, which happened in 2020 during that crisis, the COVID crisis, right? And you take the high point of 4,800, and you take 61.8% of that, you come down to about 3,200, which again is about where my moving average, not mine, but the one that I follow, would be later in the year, which because it's in the 3,000s now, every day and every month that it's above 3,000, that average will be rising, right? So in a little bit of time, you'll be able to see that probably around the 3175. And that would correspond to this moving average that was hit back at 2174 in 2020. So again, the discipline that I have is really that I like to look at here is from the moving average standpoint. And I use basically 4 different time frames. And then, of course, I like to use the relative strength because I want to know where that momentum is. And I'm always looking for divergences if I can get them. And then, of course, I'm looking at Fibonacci retracements to try to figure out where things might stop. And, that's pretty much the discipline I find interesting. And again, they're all mathematically oriented, which I find better than opinion. When people say the Fed's going to stop hiking, there's going to be 3 cuts later in the year. I don't have any evidence of that, and I'm not interested in, just conjecture. So obviously, when those type of forecasts become more, shall we say, probable, there'll be price evidence on the relative strength. There'll be price evidence on the moving averages, and there might even be a Fibonacci number to hang your hat on. But just this conjecture on where things are going based on whatever they use is not something that I am particularly interested in. I certainly listen to everybody. I love to hear smart people talk. I love to hear smart people give their prognosis, but I also want to verify it with the discipline that I've set up, that I can sleep with, that I can use risk management on, that I can sleep at night knowing I did something. If it doesn't work out, I got an idea what I'm going to lose, and that's it. So basically, there's a lot of information out there. I mean, some of these newsletters that have been around for a long time, I look at some of their ideas, and they've just basically, people have been getting wiped out with their ideas. And maybe they got a little bit of a bounce this year with this rally, but they're still way underwater from 2021. And so, I mean, I know the chat rooms and the courses and the newsletters, are very prevalent out there, and people go to all kinds of webinars, any free information they can grab to get some kind of a free hot tip. That's not exactly the way I would suggest you go. I would suggest you get your psychology in order, you get your discipline in order, and then, of course, time management is supposed to be the last thing that we speak about. And that means you're going to dedicate a certain amount of time every day to this. Maybe it's after work, maybe it's before work, maybe it's on lunchtime. You try to get a couple of hours a day where you can do your homework, keep up to date on things. But if you have a discipline, you really don't have to be staring at the screen, because you should have your exit and entry things pretty established by moving averages and or relative strength and or high points or low points. So you should have done your homework. You should have your parameters set up, and you should have your discipline set up. And when you have that, you don't have to be staring at the screen, because the screen's going to do whatever it's going to do. Now, like I say, there's a whole bunch of different ways to trade and a whole bunch of different ways to do business. But my feeling is that you want to have it automated as much as possible. Automation is not a bad thing, because then you're going to be taking out your, shall we say, emotions, because, again, emotions are very variant. And, obviously probably wears you out pretty good too. So by having some type of parameter set up, my opinion, with moving averages, relative strength, Fibonacci number, something a little bit concrete that you're working with, it can eliminate a lot of stress. And of course, the discipline of and the psychology of risk management first and foremost, that reduces a lot of stress as well. These markets tend to be volatile when they're volatile, so you don't need a ton of positions to make good money. And if you put on a ton of positions and you're wrong and you kill your bankroll, that's not going to be helpful. Also, psychology and discipline is, if the markets get choppy and, moving averages do not do well in choppy markets because obviously the market will trade through the averages and they're not trending, right? The whole idea with moving averages, they're good if you can find a trending situation. Some people use 1-minute charts and use the moving averages on those. So again, you can use the moving averages on any time frame you want. But again, if the markets get choppy, you could get chopped as well. So sometimes if you find yourself, getting hit in the head 3 times or twice in a row, it doesn't hurt to go to the sideline and wait until you see some kind of a discernible trend started to be established, and then come back in when things look like they are trending. So that's part of the discipline and psychology as well. Risk management, and again, having the discipline to see that whatever you're using doesn't seem to be working very well consistently. So maybe stepping aside and seeing, or changing markets. Some markets trend better than others. You might want to do some background homework on markets that actually trend better. Because again, with moving averages, you'll do best when you get into trending markets. And so, keep an eye on that. That I think would be very helpful. But again, the time management is, you can't be willy-nilly about that either. You have to have what? You have to have a schedule, set schedule, where this is the time frame and this is the amount of time I put in on it. And this is exactly what I'm trying to do as far as doing the homework with the psychology, with the risk management, and what's the discipline. Obviously moving averages are going to be changing all the time, right? They're moving. So you got to keep up to date on where the averages are and where's the market in relation to the average and that kind of thing. And of course, relative strength is another thing. It's not going to stay the same either. So again, you got to keep an eye on all the indicators. That takes time. That takes time management. So once you do that, and again, I do believe automation is a good thing. Meaning, if you could automate your orders, then you don't have to be making these subjective decisions every 5 minutes. And again, the discipline of what you're using should indicate what you're doing as far as buying and selling is concerned. Again, all of this stuff you can do your own homework on. And then if you have a financial advisor or a brokerage firm, you should consult them and basically make sure that whatever you're doing is in line with your financial circumstances, and that you're not, risking capital that's not risk capital, or that you're not getting into strategies that contain more risk than you can handle. And try to make sure that those things you keep in line, because on a long-term basis, like I say, short-term you can get lucky on things. You can get a hot tip. Sometimes some of the volume trading, you'll see a big volume jump in a certain stock, and you'll catch a $5 move, or you'll catch a $20 move on something. But that is not repeatable all the time. And so therefore, you have to be careful on how much you go into something like that, because again, if you do throw aside your psychology, your discipline, your time management, it's probably not going to be very well, do very well for you on a longer term basis. Now, again, this type of approach with the risk management and the discipline of the technicals that we work with and the time management we put in, you can use on any market. Okay. And that's why, as I'm recording this, there are markets that have some resistance that they've had very difficult time getting above, based on the indicators we have, and pretty much across the board. The Chinese markets have had a big run up. Everyone's jumped into them, but now they're stalled out pretty good. So they've created a resistance zone. If they can get above those zones, then you might have something to cook. S&P in this 4210 number area has been a resistance zone. If it gets through there, again, 4,300, 4,350 would be the Fibonacci throwback. So those are two zones that I'd be looking at very closely. We've got earnings this week in the Fed, so by the time the week is out, all that will be known, and maybe that'll be the impetus to take us through 4,200 and get us onto that higher level, or it'll be possibly the key that turns us the other way. Again, we had a presidential cycle, that is the second year of the president in October, which was last October, that ends in April, which is just ended. So we'll have to see if that cycle of October to April has ended, and now here in May, it's going to have some problems. But again, we're not in the crystal ball business. We try to follow the trends. So whatever the trends tell us to do, we kind of try to go with them if we can. That's why we try to stick with the discipline. Nobody's perfect, though. And even when you try to do this stuff, try to stick with it as much as you can, because, again, that'll be helpful, I think, in the long run. But that doesn't mean every once in a while you're not going to probably slip, but be careful on that. And then we've got gold, 2050 to 2100, some good resistance there. Something we've spoken about a lot, which is oil, 84 to 88. And every time it goes up into that neighborhood, it's been turning down. So if it stops turning down, then obviously we'd be more interested. Right now, it's under some duress. But again, these resistance zones that we get from our technical indicators have been pretty effective to keep us away from things that could be problematic. We had a lot of support on gold at 1800. We're very positive on it down there. But, you get up towards 2050 or 2100. It's a different game. It's not 1800 anymore. And so, we're monitoring that very closely. Should we get above resistance zones? Again, things can accelerate. So that's why, we're not going to be the ones who fight the tape, but we're also going to respect resistance, because sometimes that is where it stops. Another area on resistance is rates going lower. 325 on the 10-year, 335, that's a support zone. And as you can see, when it hit that zone, it stopped, yields stopped dropping, and now the yields have started to go back up again a bit. We'll have to see what the Fed meeting and the Fed statement has to do there. But that's a parameter that we established with our work, and that has helped us quite a bit. Again, when we have resistance zones, the idea is that would be a zone where selling type strategies, hedging type strategies, trimming type strategies would be interesting. And then, of course, if it gets and replacement trades would be interesting. If it gets above the resistance zone, then obviously you have a plan for that as well. On the support zones, that's where the buying strategies you want to look at. The hedging, if you had short positions, you'd want to look at, and other type of, shall we say, uptrending positions when you're near the support zone. So that's why we like to find where support and resistance are, so we can find out where it could be key areas to make some kind of decision. Again, the U.S. dollar. It got up to 115 on the dollar index. Moving averages were way down in the hundreds, 95 at 100. It's not if it's coming down the U.S. dollar, it's when, right? Because that's what we said. When we get way above these averages, it's not if it's coming down, it's when. Well, it did come back down all the way down to about 100. That is also an area where the moving averages are now, and the moving averages are trying to hold it up between 95 and 100 on the U.S. dollar. We also established resistance on the dollar index at 106. So if it gets above 106, we would find that very interesting, that the U.S. dollar might actually be on another run. Up until that point, it's just range bound, so we don't get too excited. We sometimes also use ratios. And so there was a ratio between growth stocks and value stocks. Growth would be your tech. Growth would be things along those lines, growth, tech, and dividend payers. So back in December, we had a turn where it said to favor, the ratio said it's turning up, so it's time to go into the growth and out of the value. And since that time, tech has obviously outperformed value by quite a lot. And we still haven't gotten a signal to go the other way. And so that ratio that got us going in December continued right through the good earnings from Meta, the good earnings from Microsoft, the okay from Google, and all through this ChatGPT phenomenon that's really been helpful to NVIDIA and other places like that. So That's another part of the discipline is, sometimes we'll look at relationships between international stocks in the U.S., between interest rates, meaning real rates, the Fed funds rate, and the inflation rate. That's a big one. M2 money growth, another big one, and M2 money has been tanking. And there's not too many instances where the markets have a great time of it when money supply is tanking. So, there is other things we do watch. Now, again, we are going to be coming up here to the end of the broadcast here, and I did want to reintroduce myself and how to get a hold of us, because I think there's quite a bit we can do for you. Now, again, the Option Professor, we've been in this thing for 40 years, so obviously we've got a lot of product knowledge. And after listening to me here, I think you get an idea that I have quite a bit of experience. We have quite a bit of experience on teaching people options, because that's what we did with hundreds and hundreds of these seminars nationwide to thousands and thousands of people for decades. So, and now we do webinars, because obviously, who wants to go to the airport if you don't have to, right? So, yeah, we have experience with that. We also have got PDF reports. One is on option trading. Now, obviously, if we've been doing things on options for 40 years, we have an idea how they work. So we share our opinion. What strategies do what? What is the use and risk of each strategy? How when you put a position on, what's your next possible move? How can you hedge yourself? I mean, a lot of people, they buy an option, they don't know what to do next. One of the things we look for as soon as we buy an option and it pops for us, we look for another option to sell, turn it into a spread. Hopefully the spread will give us our money back, meaning if we paid $3 for a call and I can sell a higher strike for $3, I get my $3 off the table, then I've got a free look at a spread. So, these are the kind of things you do naturally once you understand options and things like that. Also, we're not big on selling tiny premiums of 20, 25 ticks. There's a lot of people who promote this, sell these options with 25 cents left in them, because 90% of the time they'll go to zero. Unfortunately, the 10% of the time they don't go to zero, not only takes out any gains you have, but probably hits your principal. So, there's a lot of things running around, because obviously people sometimes fall for anything that, in our view, is not great information. So if you're hearing information elsewhere and you want to verify some stuff with us, that's what a lot of people do. Now, here's the key. We have a one-on-one with myself on our indicators, right, and your markets. So you have heard from many people. A lot of people have given you information. You come to us, you go, Jim, this is what we hear. This is what we're thinking. What does your stuff show? And we share our opinion. We don't give advice. We share our opinion on what our indicators are saying about your stuff. And obviously, we have stuff that we follow. And of course, we're more than happy to share that with you as well. So it's kind of simple. You go to the website, optionprofessor.com, optionprofessor.com, and you put your information in, and then we give you a ring back. And again, I talk about what you're going to get if you'd like to get the information, and also how we can have this 1 hour session. We don't have a stopwatch on it. Sometimes it's a little less than an hour, sometimes more. We try to get to all your questions and concerns. And again, having done it for so long, experienced people who think they're sharp as sharp as a tack, they learn quite a bit, because everyone's got a little art that's different. There's a science to trading and an art. Everyone's got a little bit of a different art. So even the experienced guys come away and go, God, I'm glad we had that conversation. And then also the newcomers, since we have a history of educating people, we certainly know how to explain options to you slowly and clearly. And also we explain our indicators slowly and clearly, so you can use them for the rest of your life as part of your research if you like. So again, we don't have monthly fees and we don't have annual fees, and we're not looking to hit your credit card every 2 weeks or something like that. And we're not charging thousands of dollars or anything silly like that. So again, give us check us out, optionprofessor.com. Put your information in. I'll call you back. I'll explain what we can do for you. It's very fair. It's very smart. And again, people have been very happy with it as well. So again, I'm the option professor, and I'm going to sign off now, so you guys can have a good weekend ahead. And again, go to Option Professor, put your information in, and let's talk. And I think there's no question there's some value we can add to your research. Okay, thanks a lot for being here, everybody. Hope you had a lot of fun listening to all the other broadcasts here this week. God bless you. Good luck and good trading. And again, we'll talk to you after you put your information in over at the website. Have a great day, everybody.